Where does oil go from here?
Well, there's two offsetting dynamics here. One is that we look at the underlying economic background. It's one of the strongest global synchronous growth backgrounds we have seen since the 2004 era, where commodities really went sharply to the upside. But the offsetting force to that is this new oil order, meaning the shale revolution is still very much underway, putting downward pressure on long-term oil prices. So while you have upward pressure on the front, you have downward pressure on the long-term price, which is creating a rotation in the oil forward curve, is creating a term structure, what we call backwardation. And that's really where, while we expect oil prices to remain flat to maybe slightly down here, the investment returns we think are going to be significant, really being driven by the shape of that forward curve. Investors go out, buy at a discount, roll up on the front end. So prices potentially flat to down, but upside in returns driven by curve shape.
Right, but how long can that last? And I'm also looking at research, for example, Citigroup saying that wild cards, including war or Middle East tensions, could drive crude to $80 a barrel.
Well, I think the key there is to get up to $80 a barrel, you would have to have that back end of that forward curve become unanchored. And if you think about 1 year out right now is trading around $61 to $62 a barrel on a Brent basis. You look at the cost structure of this industry, it's still in that 50 to 55. That gives significant returns to producers who are going to sell the back end, anchor it, which is why we think the upside from any of these disruptions around the world will be captured in the shape of the curve, not in the price itself.
Okay, is there a sweet spot for OPEC members? If OPEC members see prices rise, for example, Brent above $60, does that not mean that shale producers come back online?
Well, again, it's because it takes time between when the investment occurs and when you get the production. The key is really where the forward price is, not where the spot price is. And I go back, forward prices 1 year out are trading somewhere around 61 to 62, cost basis of 50, 55. That's what they're targeting. If you can keep that back end anchored, that front end can do whatever it wants, because the investment into shale does not take place on that front end price, but rather on that back end price. Now, in terms of where do they want prices to go, getting too far above 70 starts to create the risk that central banks respond to the inflationary pressures off of higher oil prices. I would tend to think that OPEC members do not want to see that, and that in general we'll probably see more noise and rhetoric if prices trade above $70 a barrel in the coming days to push this market back down to lower levels. But I think the real key here is look at those forward prices. Where are they anchored relative to the price? Because that's the signal for investment, not the spot price.